Welcome to this week's Simple Market Update. My name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning. And in this video, we're going to discuss the state of corporate earnings, how they've been impacted and affected by consumer behavior, and how earnings data impacts the overall trajectory of the stock market. Markets have rebounded from the swings experienced at the beginning of August, and the S&P 500 is approaching a new all-time high, driven in part by Fed Chair Powell's recent speech, all but confirming a September rate cut. Corporate earnings have been a key focus for investors, with the S&P 500 earnings rising 7.4% over the past year, and the second quarter earnings growing at 10.9% based on the data so far, which is on track for the fastest pace since 2021. While 79% of S&P 500 companies have reported better than expected earnings, revenue growth is below the 5-year average. And future sales trends will depend on consumer and business spending patterns. So in the next few minutes, we're going to discuss how earnings and consumer spending impacts the markets and investor portfolios in the long run. First, this chart shows the S&P 500 index in navy alongside its trailing 12-month earnings per share represented by the blue shaded area. As you can see, though they are not in perfect lockstep, the stock market tends to follow earnings over the long run. When earnings rise, the value per share tends to rise as well, depending on the valuation levels. The growth of earnings tends to track economic growth, so a healthy economy can drive stock market growth. So although the stock market and economy are not the same, they tend to follow one another over long periods of time. The gap between market performance and earnings reflects stock market valuations, such as the price to earnings ratio. Recent market pullbacks can be seen as healthy adjustments giving expensive valuations in recent years, and can even serve as periods of opportunity for investors. But of course, we would never recommend market timing behavior. Next, this chart shows the household savings rate as a percentage of disposable income, with the horizontal dotted line showing the average savings rate. After an exceptionally high rate of saving during the pandemic, households are now saving just 3.4% of their disposable income, which is slightly below the average historical rate. From a financial planning perspective, this is far from ideal. However, from a market perspective, the question is whether this is sustainable. In their recent earnings calls, many companies expressed concern over consumer financial health amid economic volatility and several years of high inflation, with executives from major brands noting a shift to more budget-conscious consumer behavior. So although consumer spending data showed unexpectedly high recent growth, declining savings rates are likely to impact future spending patterns. This will depend on other factors such as larger paychecks and overall consumer net worth. And finally, this chart shows the total net worth of households and nonprofits as reported by the Federal Reserve. It shows that household net worth has reached new record levels, though liabilities have increased as well. Moderating inflation, anticipation of a Fed rate cut, and the current market rebound all help to support consumer spending and sentiment through the wealth effect. Healthy corporate earnings growth is also helping to support long-term market performance. A reminder that it's important for investors to focus on the broader trends of economic growth rather than day-to-day fluctuations. We hope you found these insights helpful. If you'd like to discuss this in more detail, please feel free to reach out. We look forward to hearing from you, and you can go to keepitsimplefinancial.com to learn more about what we do.